Let's get started. First of all, my name is Nasrin Nourizadeh with FCIA. I'm also on the board of directors of ITFA Americas. And I wanted to thank 1TCC for hosting this event and getting us together here. And also ITFA, who I'm going to introduce here for those of you who may not know ITFA. ITFA is the International Trade and Forfeiting Association. In the past, it used to be called ATFA, Association of Trade and Forfeiters in the US, and we merged with ITFA as of a couple of years ago. So we are now ITFA Global, and now we have our chapters in the Americas, in Europe, and other places that we go through. But basically, ITFA is an organization that connects people. And although majority of our members are banks, however, there are also insurers, brokers, companies, commodity traders, lawyers, and more. Currently, it has 320 members. It was founded in 1999, and it is active in 50 countries. The beauty of becoming a member of ITFA is that the membership is global. So even though you pay one fee, but wherever your colleagues are, they can attend the seminars and conferences. Seminars are typically free of charge, but the conferences are usually for a couple of days, and there is a fee obviously attached to it because it will include dinners and lunches and all of those things. The mission statement, you can read it for yourself. All these slides will be shared with you, but it has a great focus on networking. It's really the best value that personally I have received through ATFA or now ITFA. Most of our clients have come through, our bank clients have come through the connection through ITFA, and it's a great place to meet people. And it also has a great focus on education. Teaching the best practices in the industry, sharing the ideas, and collaborating with also other organizations that are working in trade and trade finance. So they, try to help each other out and share ideas with each other. And they publish a lot of, white papers, topics trending in the industry, and they have a lot of different committees and functions that they will go through it. It is active in all these countries, and the biggest chapters are in the US and Canada and in the UK, and but there are also active members in other countries that they have local events as well. The committees are basically mostly focused on education, market-based practices, fintech, insurance, environmental and social, or ESG. Emerging leaders, we try to help young people elevate in their careers, and also we have some relationship with multilaterals that try to learn what they're doing and share that with our base. If you visit ITFA.org, you can have access to majority of what I told you. It also gives access to members to directly contact members. A lot of organizations don't do that, but ITFA makes this possible, and you can always reach out to another member, ask questions, and connect with them. And of course, they have events that are all listed throughout different countries, and you can attend as you see fit. So now, I'm going to pass it on to Peter, that he's going to introduce 1TCC and go over his presentation.
Good afternoon. I'll do the slide transition here. So my name is Peter Hasenkamp. I'm an advisor to 1TCC. I've been working with the company for about a year, and I'll give a little bit of an overview of 1TCC, and then talk a little bit about the automotive supply chain. So my entire career has been in the automotive space, and talk a little bit about where automotive is the same or different than other industries. But a couple of you were asking actually as you came in, what is 1TCC? What does 1TCC do? 1TCC is an inventory, I shouldn't say financing platform, but it is a way for manufacturing companies to move inventory off of their balance sheets, and 1TCC will step in, manage that inventory for the customer, allow them to free up working capital to be used for other projects. It's an area that banks aren't allowed to participate in, so it offers kind of an interesting opportunity. 1TCC has been around for about 2 years. Mike Doran is one of the co-founders, is with us today. And Mike, can jump in if I miss any key.
You're doing fine so far.
Topics here. So 1TC's whole purpose is to provide free working capital to manufacturing companies, and lean inventory optimization and management. It allows companies to have asset-light balance sheets, better financial ratios, and improve their cash flow. Essentially, 1TCC comes in, takes over inventory ownership, and can then provide that working capital back to the company for their usages, as well as work with the suppliers who are manufacturing goods for the company, sometimes with better payment terms and that sort of thing. And I'm sure Mike or Hula or any of the other 1TCC folks here will be happy to talk more about that. The company participates and is actively working with automotive customers in the automotive vertical, pharmaceutical, and high-tech spaces. So basically any manufacturing business where you do have a lot of inventory. And automotive is definitely one of those. As I thought, I spent most of my time talking about the automotive supply chain. As I said, that's where my background is. I've been in the automotive world for 24 years now. Spent the first 10 years of my career at Ford Motor Company in product development, and then joined Tesla in 2009, actually shifting over to the supply chain side of the business. Spent 5 years building up supply chain from scratch at Tesla in the early days, and then moved over to a company called Lucid Motors, which is another electric vehicle manufacturer. Spent 8 years there doing the same thing over again, so I've worked firsthand in terms of managing supply chains, building those relationships, participating in this tug of war, and competing priorities, even within a company, between finance and supply chain, or between a company and its suppliers, trying to meet everyone's priorities, right? And the automotive industry, is I think a very old, well-established, mature, very competitive industry. I think it has some really interesting nuances and elements to it. You've got obviously a tremendous amount of money in the industry. It's been around for 100 years, global in nature, highly globalized. But even in that era of globalization, you've got very, very narrow niches of suppliers where you really do have kind of oligarchies for specialty parts. Things like braking systems or airbag controllers, these sorts of things that are safety related, safety critical, very, very difficult to develop. You have very small numbers of suppliers that are still around that make these parts. So it kind of lends itself to very long-term partnerships between automakers and their suppliers. You've also got very long development cycles. It takes anywhere from 3 to 7 years to develop a new vehicle or a new platform from the ground up. So you have to have these very well-established supplier relationships that go on for a long time. And at the same time, right, it's been around for 100 years, with the exception of kind of the electric vehicle revolution over the last 10 to 15 years, it's been a somewhat mature and stagnant, industry, that's very, very cost-driven. The financial teams at automakers are pretty sophisticated, really leverage a lot of financing tools, right? So something like an inventory trading platform, is I think attractive to those companies to free up working capital. I always compare the automotive supply chain a little bit to the old married couple. They may bicker, and fight from time to time, but they'll never leave each other. These relationships are entrenched. I would say long term, but very, very entrenched. As I mentioned, there's some suppliers, right, that provide very special parts, and once you've picked a supplier to make your airbag controller for your car, you cannot readily switch to another supplier. So it's an industry that has a high degree of single sourcing. You're not able to be like the consumer electronics industry where you can have 5 circuit board suppliers all providing the same parts. You have the volume, and the cost of the parts is low enough that you can have multiple suppliers. In the automotive world, even at big companies like Ford, most parts are single sourced. So you've got you really do have a supply chain there, right? If the supplier breaks down, if they have a shortage, if they stop work, it cascades very rapidly into the automaker. It's also a very highly globalized supply chain, right? For any North American or any American-made vehicle, right? On average, 30 to 40% of those parts are coming from global suppliers. Obviously, a lot if you include Mexico and Canada. In that, but American made really just means these days American assembled, right? A lot of the parts are coming from all over the world, and those large global supply chains can be quite fragile, but they can also be very slow moving, right? If you find that people see headlines these days, electric vehicle demand is not what people expected it to be, right? Cars pile up on the dealer lots. You might have 26 to 50 weeks of supply chain of material coming, from India, China, wherever. So it's also very difficult for those supply chains to react quickly in most cases. So then if you look at the kind of the forces that affect the supply chain, some of them are pretty common across all manufacturers. So I think the upper ones here, are endemic to any manufacturing company, right, that has been dealing with chip shortages and the pandemic. It's kind of scars from the pandemic in terms of general supply chain chaos. And trying to maximize, profit margins. The items down here are a little bit more, automotive specific. Automotive has gotten into this mentality of just-in-time inventory, where you literally have a car factory that has 3 hours of inventory on its floor, right? And then you have a supplier who's within 5 miles that might have a day of inventory, right? And you have to go 2 or 3 layers down the supply chain before anyone's holding a week or 2 weeks of finished goods, right? The push for price competitiveness and cost competitiveness has driven companies, and I think also a degree of comfort in a well-established global supply chain that operated smoothly for the last 20 years until the pandemic came along. Auto companies really looked at cutting every margin out of every step of the supply chain, right, reducing inventories all the way, and just in time was what everyone aspired to be, and that's now kind of catching up with people, right? I mentioned single sources, right, where you've got now very lean inventory, one supplier for that critical part of yours, and also the market demand instability right now, right? You're seeing things like electric vehicle demand fluctuating rapidly. I was looking the other day, and I looked at 2 well-established kind of industry forecasting sources. And one said that by 2030, electric vehicle penetration will be 30% of all cars sold. The other one said 20%. I mean, you're just huge uncertainties in how quick adoption will come, and that also can be attributed or assigned to other vehicle mixes or options. How many people are going to buy, right, the premium level vehicle versus the entry level vehicle? So those market demands shifts really cause a lot of chaos for supply chains in automotive. And then global risks. When you have one single supplier and very, very lean inventory, a natural disaster or any sort of global event, whether it's geopolitical or natural, can really topple things, right? When the Fukushima, I don't think had as big an impact, but the tsunamis a decade ago or more in Asia, right, wiped out one specific paint factory, which was the only factory that Toyota used to make black paint. So for 6 or months, 4 to 6 months, no one in the world could get a black car. Right? It was literally this one ingredient that had to go into the paint. It was single sourced globally. And you see this happen from time to time. I mean, there have been fires. There was a fire at a Ford factory, a Ford supplier's factory in the Midwest, that shut down the F-150 line. Right? That's Ford's most profitable vehicle. They sell 700,000 of those a year. And it was a magnesium casting supplier that had a very, very large machine to make this big front end carrier where the radiator goes in the car. Ford, I think, was shut down for something like 6 weeks. They had to, if anyone knows what an Antonov is, it's the world's largest freight plane. And they had to move this tool, which is about the size of this room, almost like a tank, basically, and fly it to Ireland. Because the closest supplier that could run that tool was in Ireland. So this kind of gives you a little bit of, hopefully, some anecdotes around just how fragile the automotive supply chain is, right? It's been leaned out to inventory minutia. It's single sourced, and there's some very specific parts that aren't very easy to shift and move to someone else to make for you. So that leads you to kind of a classic tug of war, right? The finance teams inside the automakers are looking for capital efficiency and lean inventory and good balance sheets. Supply chain are really looking for just in case, not just in time, especially after the pandemic, semiconductor crisis, all of that sort of thing. And then you can throw in also some of the recent discussions going on, a balance between offshoring to optimize cost and nearshoring, right, to protect your supply chain, to reduce your supply chain risk, which oftentimes comes at some cost. So you've got this tug of war. It's been going on in a lot of manufacturing companies, but particularly in automotive. So who's winning that tug of war? Rania was kind enough to put this together for us a little while ago. But if you look at kind of the recent inventory growth in the automotive space over the last 5 years, everyone's up, right? And it's not too surprising, right? I think you're seeing a little bit of a whipsaw effect of companies realizing that they got a little too extreme in offshoring, a little too extreme in just-in-time inventory, lean optimization. And they need a little bit more selective strategic buffers of inventory, right, to make sure that they can run their business in a normal, orderly fashion. And that's what I think has made 1TCC interesting to automotive clients. It's what brought me into the mix when Sanjay and Mike reached out. These companies have huge cash demands for vehicle development costs, in the billions of dollars. Their tooling, their factory, just the amount of investment required to make one single model of a vehicle. And to bring a new vehicle to market these days is $3+ billion. And they're also making significant investments in electrification, retooling factories, all of this sort of stuff. It takes obviously a lot of cash. And their finance teams, as I mentioned, are used to asset-backed financing, using all of these kinds of credit and financing tools, factoring, forfeiting, right, to optimize their balance sheets and get them the cash they need to run their business. And then you've also kind of coupled that with this extended global supply chain, with growing inventory and companies looking at where they hold inventory and buffer stock to be able to make sure that they have de-risked their supply chain as much as possible. And then you get a good combination of elements where you've got this tug of war now, and 1TCC can step in and provide a little bit of relief there by taking on ownership of some of that inventory. Right, supply chain team can have their just in case buffer stock and inventory. The finance teams can shift it off their balance sheets, and everyone kind of gets what they're looking for. And as I said, I think the company's getting good engagements across a number of industry verticals, any manufacturing sector, but automotive particularly is a good target for this kind of tool set. And it's an area that banks don't participate in, so it's also an opportunity as well. So that's a little bit about the automotive sector. Can I answer any questions for anyone? Yes.
So is this inventory that's already been purchased?
So yes, it's inventory that has been. I guess it can be a couple of different things, right? If you're looking at, a customer, buying inventory, is if they're buying, FOB China or wherever, right? And it's going to be on the water for 10 weeks, and then they want to have 2-3 weeks of, North American-based inventory on in a warehouse, right? For local safety factor, you can have a couple months, 3 months worth of inventory totally in transit. That's the company owns, and that's what 1TCC can step in, right? Receive the purchase order instead of the supplier in Asia, take ownership of that inventory, and then meter it out to the customer on a just-in-time, as-needed kind of call-off when they need it, and own the inventory during that whole in-transit and warehousing time.
So you guys have your own warehousing, or you can set up your own warehousing facilities?
So the platform can be implemented without disrupting the physical flow of goods. It doesn't require TCC to move inventory into a separate warehouse, right? It can all be done electronically, really. Because once the purchase order goes to that supplier in Asia, they say they're ready to ship the goods. Right? If you shift that electronic messaging stream, so it goes to TCC. TCC takes ownership at time of shipment, and for that intervening period of time, electronically from a title perspective, TCC owns the inventory, and you don't actually have to change the physical flow of goods. It requires some pretty good software and programming, right, to be inserted in the supply chain. But with companies like automotive firms, they all do electronic messaging for all of their purchase orders, and their long-term purchase orders. You're talking about years of production. So everything's set up in a highly automated fashion. So really all you're doing is you're inserting TCC in that flow of information and then taking title and ownership of the goods while in transit.
Maybe just add to that, we can set up warehouses if clients want us to, the 3PL. Generally, they don't want us to. We don't own warehouses. That's not our business. We're never going to own.
Yeah, you're just going to leave it where they are. You're just going to title.
Normally, yeah, that's what most companies want. They want it to go exactly the same way it's gone in the past. You think about the way they handle consignment inventories now. They're sitting in the customer's warehouse, but they don't have title to it. And that's how our inventories generally work.
Okay. How do you guys compete with someone who's in the space already, like Wells Capital Finance or some of these other firms?
They actually aren't. They're lenders. We're not a lender. We take title to the inventories. So we're more like a distributor than we are a lender.
Okay.
The banks, actually U.S. banks can't do this because you can't use depositors' funds to buy physical assets. You have to invest in financial assets. You have to make loans. Some foreign banks have been able to do it in the past. B&P in particular, Standard Chartered used to do this. But their own capital controls have tightened up since 2008, and they've all gotten out of the business directly. So if a bank wants to do this business, they have to partner with someone like TCC. There's not a lot of people like TCC.
So who's the funding behind you guys?
We can work with a lot of funders. I mean, large international commercial banks generally. If the client is investment grade, the cheapest source of capital is to get a revolving line of credit from a commercial bank. If they're just below investment grade, if they're double B, say, we have non-bank lenders like private equity funds
in automotive
that will do it.
Yeah, double B and single B in automotive a lot.
Yeah. The challenge with automotive is finding investment grade. Single B is
a challenge, but double B, there's a lot of lenders that will step up to that.
Yeah, it's not historically a strong financial segment of industry. But we also have Chris Parga, comes from a logistics background, so he also has seen directly firsthand, how much inventory, gets in transit inventory gets stored, and so we are also working through some 3PLs and logistics companies, right, where they may have customers that can take advantage of this kind of financing tool.
So how do you guys partner with someone like, say, Nasrin and the FCIA Great American? Is that on the purchase order side, or how does that work?
Maybe I could address that. That really is for the clients that aren't investment grade. If they're investment grade, we can borrow without credit insurance.
Sure.
But below triple B, then the banks lose interest, and there is a space for credit insurance for lower. If we can get credit insurance, together, if that allows us access to cheaper borrowing and the total cost is less than the total cost from a non-bank lender, then credit insurance is attractive.
But Nasrin, is that because it's being done on a pre-shipment basis? Is that how that coverage is working?
Well, we haven't really talked, but about credit insurance together. But
I mean, it sounds like it because there is an actual order. It's just that title hadn't changed hands yet.
right.
Okay.
And credit insurance is not for inventory; it's for receivables.
Yeah, or in this case, pre-shipment risk.
But I appreciate that.
Yes.
So the other aspect is the off-balance sheet aspect. Can you expand on that a little bit?
You mean in terms of just the accounting treatment?
Yes.
So yeah, this is a discussion we have to have with each customer's accounting teams, right? And some of them are have internal policies around against inventory financing or this kind of mechanism, but I think we've had good traction, and I guess Mike, if you can speak to substantiation around the off-balance sheet treatment.
Yeah, so there are a lot of issues around the accounting, of course. And I'd say they're very nuanced. So the contracts have to be drafted to address the nuances. But basically, FASB gives you a lot of guidance for GAAP reporters. There's a 6-factor test for who has control of the inventory. Having legal title is a great, argument in our favor. Having it physically in the customer's warehouse is a hurdle. We have to demonstrate we actually control that inventory, even though it's physically in the customer's warehouse. We have contracts drafted to address that. And I would say with GAAP reporters, we can probably satisfy about 80% of the auditors. It's 80-20 rule. There's some of them that are never going to buy the off-balance sheet treatment, quite frankly. But most of them, I think we can persuade. With IFRS, it's a little bit less defined. They don't have the same kind of guidance you have in FASB, which is kind of a two-edged sword. It actually gives the auditors more leeway to sign off on the program. But also gives them less guidance. So we basically point to GAAP and say, well, the principles are the same, even though you don't have the same, detailed guidance. But that is definitely part of something we have to work through with every customer, and their auditors.
But Mike, you kind of mentioned distributors in the past, right? So certainly when I was running supply chains, we had several VMI suppliers, vendor managed inventory, right? Fasteners on a car, right? We would hire a distributor, who would work with 20, 30 different companies, right? They didn't fabricate any of the parts themselves. They were a distributor, and they would own the inventory. They would own it inside the automotive factory, right? And they would basically just bring a box to the line when you needed those parts, right? So then, this is substantially similar to that sort of model. So I don't think, as you said, I think we've been able to persuade 80% of customers that it's similar to that sort of situation of vendor managed inventory.
And having a platform also helps, make a case for the accounting for off-balance sheet treatment, because we really insert ourselves in the supply chain operationally as well as financially.
But to be sure, the supplier has to be paid. So TCC is not a funder, so you will bring a funder, right?
Right. So we borrow the funds to pay the suppliers.
Well, TCC borrows the funds?
Yeah, we're the borrower. We have legal title. We place the purchase order with the supplier, and the goods go on our balance sheet. We have legal title, and we're the borrower. For the banks, there's a needle to thread. From the bank's perspective, this is basically structured finance. They're not looking at our credit. They're looking at our client's credit, right? From the auditor's perspective, it's absolutely not structured finance, because if it is, it goes on their balance sheet. So that's the needle that we have to thread.
Or at least in the space we've seen with a lot of this purchase order financing, if I can call it that, that's close to it. There's been a lot of fraud. So how are you guys basically validating? I guess if it's your warehouse, it's easy enough. But how are you validating that the actual product is there and it's not been sold 3 times to somebody else? Yeah.
So the primary protection really is who you do business with, right? It's, investment grade clients don't do that as much, but we do have a lot of rights. We can go in and physically count everything. And, we have penalty provisions if we go in and count and you're short, it's going to cost you. And, that's a good thing to do the day before the end of a quarter when people are most tempted to do that kind of thing. It could be a profit source too.
I mean, we've seen it happen with good companies as well as who you would expect. And it just has to do with what are their internal controls.
Yeah. So, the way our offering works, they're paying us for the time the customer pays us for the time the goods are in inventory and for the time they're AR, right? So they don't really have a financial incentive to underreport or time and inventory, right? They're paying either way, right? I guess there is a possibility the inventory doesn't exist at all. The existence of inventory.
Or it's been spoken for to 3 different people.
Yeah, but there's checks and balances when you're working with a warehouse management system and you have inventory available. It's usually only available in one spot. Being able to take it would not be on the client's books. It would be on our WMS or on our inventory. So they would know that there's inventory out there, but they wouldn't have the specific information to that to be able to resell it or to do anything else with it. So it's technically not on their books.
Since we have title, it's a little bit different from, manufacturer pledging the same inventory to 3 different lenders because they don't own it. It's our inventory. They can't pledge it.
To the extent it's in your facility, but if you're basically financing it and you're using their facility, you're going to have to.
It raises the bar on the fraud, because it's not just pledging more than once. It's pledging something you don't own.
Yeah, effectively.
Yeah, it requires good audit provisions for sure, right? But from an electronic fraud perspective, right, you've also seen a lot of increase in cyber theft and whatnot and spoofing I've seen a number of purchase orders, accounts receivable, that sort of thing. But with an industry, again, if we apply the 1TCC platform to automotive, it's the checks and balances happen at the front end when you're setting up those communications, right? So if you're using EDI messaging for all of your purchase orders and shipment notices and all that, then you're hardwired together. So I think you can de-risk a lot of the upfront, risk in terms of purchase order, shipment notice, traceability, inventory, messaging sorts of risks when the platform is implemented and set up. But then the primary risk is around inventory shrinkage and the ongoing audit. Yeah.
Do you extend longer terms to the buyers? Or do you re-invoice at all, or you keep the original?
No, we can change the payment terms as well, right? So that's another negotiable thing. We can extend the payment terms with the buyer, right, and shorten them with the supplier. So kind of overlapping a little bit in the forfeiture or factoring space as well. So then you can have multiple solutions in one.
So what's the maximum payment terms?
It's been negotiable. I think we were looking at 90 days.
So our standard are 180 days in the inventory, 120 days on receivable. But we do have some flexibility in that. But for lenders, 360 days is kind of right line. You go beyond that, and interest rate's going to be higher, and also their credit decision is different. So we try to keep the whole cycle under 360 days.
And when you talk receivables, are you talking the receivables of the supplier or the buyer?
I've got our receivables, so
Oh, yours.
yeah, from our customer. So from our perspective, the suppliers is payable. We owe them the money.
Right. And you pay them right away.
Well, we ask to inherit the same terms that our customers have. It's kind of part of the introduction that we ask for. So if they're getting 90-day payment terms, we're pricing our offering to our client based on 90-day payment terms. If the supplier wants to get paid in 2 days, we can do that, but they have to take a discount off the payable. That's a separate negotiation we have with the supplier.
And you take title of the inventory while it's on the water, so the buyer doesn't have the inventory on their balance
We
sheet.
can do that, yeah.
Yeah, it's very applicable for global trade particularly, right? Because then you're talking 9 to 12 weeks depending on where it's coming from and all those sorts of things. Plus, most companies want to hold some measure of local safety stock, right? If they've got a global supplier and they've got extended inventory on the water, they typically want to carry 2 to 4 weeks of local inventory on site, right, just as another insurance level, so then you're magnifying the amount of inventory that's in transit, right?
Have you guys, how many of these deals have you done so far on the platform?
So we're a startup. We're actually onboarding our first client right now. We have a large European pharma company. We're doing a $300 million program for
Pharma?
Yeah.
Okay.
Yeah, that wasn't our intention to make that our first
Whatever
industry.
comes in the door.
But exactly, we had a great referral into them, to their CFO, and they want to do it. So we became experts in pharma real quick.
Okay. Yeah. Know the drill.
Yeah.
Compliance.
Meeting with an automotive company's CFO next week, right, on kind of the final reviews of the proposal there as well. Okay.
The agricultural goods are also another area because of the seasonality, because you have a harvest and then you have inventory, and this inventory is not consumed immediately, it's consumed the following months and weeks and months, so.
Might be another opportunity.
Yep.
Well, thank you very much. Appreciate the questions and interest. I'll turn it over to Nasrin for the next session.
Well, I'm going to talk about credit insurance, and so there are a lot of credit insurance people in the group, underwriters, brokers, and so many of them are very knowledgeable on this product. But nonetheless, I introduce myself again. I'm Nasrin Nourizadeh with FCIA Credit Insurance, and so I got this from the S&P Global Market Intelligence. They're having a lot of talks about the rise in the bankruptcies again. In fact, in 2023, the bankruptcy filings were twice the 21 and 22, and is on par with the number of bankruptcies before the pandemic. And many of them in their bankruptcy filings mentioned that supply chain was a trigger that caused the basically the bankruptcy. Also, longer payment terms contributed to the tightening of the cash flow, and also that also helped the expedition of the bankruptcy filing. So, how can we mitigate the delayed payments or non-payments? One of the very useful tools in this area is trade credit insurance or accounts receivable insurance. Basically, every time there is a credit to a buyer, there's a chance of non-payment. And the non-payment can be as a result of commercial events such as bankruptcies and again, lack of cash flow to make the payments to the buyers. Or it could be, if it is export sales, it could be political events such as government intervention, forex controls, and wars, and other things that can delay payment from even established clients. They might have difficulty to get the money outside the country and make the payments. In fact, I've had some claims in the past that the client had the money, the buyer had the money inside the country, but the government didn't let them send the money out. So the insured filed the claim, they made the payment, and then when the rules changed and the buyer was able to send the money out, we were able to recover. I don't know if it is a privilege or bad luck, but I happen to be witnessing two of the largest crises of our lifetime. I have been with FCA for, it's gonna be 17 years now, this August, and I witnessed two crises. The one that we all recently we experienced, the 2020 through 2022 global pandemic that created a lot of bottlenecks in the supply chain, and a lot of default happened as a result of lack of business and lack of products to put the products together. And the other one was the 2008-2009 financial crisis, which again resulted in the domino effects of non-payment through the supply chain. And really that highlighted the importance of knowing your customer and the customer, because even though you might have a solid customer, if you look at the supply chain throughout, then you may realize that, there are some big chains throughout, and that can affect your cash flow. So those companies and banks, and also backed by credit insurance a lot actually, those banks and companies that had credit insurance during this crisis, they weathered the pandemic or the financial crisis very well. Their claims was paid, and so the best time to buy credit insurance is really when you think that you don't need it and everything is quiet and everybody is paying on time, because the crisis and defaults happen when you don't expect them. The value added of credit insurance are many. As a few are mentioned here, sales expansion. When clients or your clients have credit insurance, they feel more comfortable by selling more, either upselling to existing clients or getting to new markets and selling to new clients, or extending payment terms. If a client is getting 30 days and they're coming back and saying that I want 45 days or 60 days or longer because your competition is offering longer terms, if you don't give it to me, I'm going to go to the competition. If your insurer approves that payment terms, go ahead, give it to them. So you can easily keep your clients and keep them happy. Balance sheet treatment that was mentioned, it's another reason that a lot of companies actually use credit insurance. Instead of showing receivables and showing debt, they discount the receivables and they show cash. And they also avoid the volatility in the cash flow by non-payment of some of their clients. They also can reduce their bad debt reserves by moving that reserve to the working capital and basically increase the working capital and therefore borrowing less and paying less cost of funding. Access to financing, this is the key for a lot of clients, because when oftentimes companies take their receivables to the bank and borrow against that, and if there is concentration on certain buyers or there are international buyers that the bank may not feel comfortable with, they may not include those receivables in the borrowing base, and the bank may require credit insurance, and when they obtain a credit insurance, then all those buyers will be, all that receivables will be included, and therefore the bank will give the money at full rate and at the lower cost as well as at a higher advance rate, which is key for the client. So basically, the cost of credit insurance would be the wash because they get a lot more money at a lower cost and get the financing that they need. And of course, there's always protection against unforeseeable losses that you may never know where it comes from. Eligible sales of goods and services, basically all the goods and services are included. The mandate for trade is trade. So it has to be trade, and anything that is a trade basically, or services could be included in this type of protection. Minimum premium varies by insurers. But for FCIA, minimum premium for if it is export only is $15,000. If it is domestic only, $20,000, and if it is combined, also $15,000. But different insurers have different minimums, so you need to consult them for their minimum. Different insurers, different underwriting approaches. There are two main underwriting approaches that currently we see. It's random underwriters, which is basically they write cancelable limits. Their philosophy is that they want the client to outsource their credit function to the insurer. They say, don't worry about anything, we take care of everything. So any buyer that you might have, you need to basically upload to your system, and the system will say yes or no. If it's a large limit, then human underwriters will review it. There will be, of course, some cost to that. There will be buyer underwriting costs. There is a fee for domestic buyers. There are higher fees for exports. And since they're in charge of approving your buyers, they're also in charge of canceling the limit. So it's cancelable limits, and technically, the insured will agree that as of the day after inception of the policy, the insurer has the right to pull the limit at any time they feel like, the quality of risk has changed. And because typically these underwriters, these insurers are global, and they have a lot of exposure in different sectors, So they have kind of a pulse of what this sector is doing. And even though the buyer, your buyer may be solid and paying on time, but because they see the whole picture and they need to protect themselves, they may pull the limit, even though they are completely happy with your client. So you need to know, what you need, your needs are, and what you want to do. On the other hand, there's another school of thought, and that is excess of loss underwriters. So FCIA, AVAC, and many others are the excess of loss underwriters. So the way we do it is that typically the policies are non-cancelable, meaning that the insurer cannot pull the limit mid-term. So the limit is for the term of the policy. That doesn't mean that if there is a non-payment or a past due, you continue shipping because you need to protect the insurer as well. So there is a limit up to 60 days domestic, 90 days international, that if you didn't get paid, stop shipping, even though there is insurance in place. Otherwise, you are on your own. But any purchase order that was before that in-house, it will be covered. At least it is with the FCIA. So the policies are not non-can, and the way the FCIA or other excess of loss market would view it is, if it's, for example, a large portfolio, we look at the 80-20 rule. If 20% of the buyers are basically bringing 80% of the revenue, then what we would do is that we underwrite and name those larger exposure to the policy, and then we give delegated authority to the insured to approve their own buyers, smaller buyers. And depending on how good they are, that authority could be higher or lower. And every time that there is that type of delegated authority, which we call it discretionary credit authority, or in short DCL, there will be a deductible. So let's say that there is $100,000 delegated authority, there is a $50,000 maybe or less deductible. That deductible is just once. And once that is exhausted, it will not be reestablished. And so that's why it's called excess of loss. So the first loss basically will be covered through, if it is more than that deductible, of course the rest will be paid, but the first loss will be exhausted through the deductible, and then after that, everything else will be paid out. But a lot of companies love that, because basically they are not disrupted. They don't have to constantly go back and forth and get permission to sell to the buyer. They can approve the buyers. They don't need to even report it. They have the guidelines, what they should follow, either their own guidelines or the insurer guidelines. And it's very simple, and coverage is for all of their buyers, and therefore their business can be, has a good flow and no disruption. A lot of companies prefer that. There's also Exim Bank. What does Exim Bank do? It's basically export insurance only, so you cannot take your domestic sales to Exim Bank. And Exim Bank, the mandate is really to create jobs and save jobs. So they don't have a minimum. It can be a few $100s. And it is really to support the exporters and small business, to help them grow. And they might have a $300, $500 premium on a policy, but this is not something that the private insurer can afford, because the administration cost will be too much. So this is mainly for a smaller business. And FCIA, as I said, is one of the excess of loss markets. There are different types of policies available. The very typical one is the multi-buyer policies, which is basically, it can be the whole portfolio of receivables, whether domestic, export, wherever in the globe, or it can be a key account. So a client may decide that they don't need to cover all of their buyers. They are not worried about the small buyers. They're only worried about high concentration risk. And that's where they can bring their large accounts and get insurance against them. It could be 10 buyers, 15 buyers, 25, whatever it might be. And as I said, the coverage can be domestic or domestic only or export only. It's really what the client needs. Typically, the policy term is 12 months, and it's a renewal policy. And the payment terms vary depending on every client. Every company has a different, depending on the sector. It might be 30 days, it might be 60 days, it varies. And sometimes they have tiers in their receivables, and that could be acceptable. Maximum limit is obviously 360 days in a year, but typically we see payment through 30 days to 90 days, although there are also 180 days or 120 days as well. FCA has two types of multi-buyer policies. The non-can policy, which is the limit is locked in, and it is less administration. The premium will be charged at the inception, 80% upfront and 20% reconciliation as whether the client sells more or not, just in case they miss their sales projection. And the indemnity is 90%, so there is a 10% co-insurance. We have another policy which is called pay as you go. Exim Bank also has the same policy because we used to write the book of business of Exim Bank for 30 years. And therefore they adopted all of our policy language, wording and everything, as well as many others. But basically, even though this one is cancelable, but when FCIA looks at the risk, it rises with the concept of whether I am able to keep the risk for the term of the policy. So even though it is technically cancelable, we never cancel. And the reason is that if we believe that people buy a policy, the coverage for when they need it. If we pull the limit mid-term, basically we are hurting their business. So we will never do that. The advantage of it is that it is easy for a small business because it is that the payment is at arrear at the end of each month. They send us a shipment report and they send the premium. And if at the inception, for example, especially in commodities, the prices go up and down. And let's say that the inception, the prices are at peak, and then 6 months later, 2 months later, the prices drop. So in the beginning, they may, let's say the client thought that they're gonna sell $50 million in sales. And the policy, let's assume that was $50,000. Mid-term, the prices have dropped. So by the end of the year, they only have sold half of what they expected. And half of what premium that they expected to pay, they have paid us. So long as they have made the minimum premium, they don't owe us any money. So we are not going to invoice them for, let's say that policy was $50,000, we are not going to invoice them for the rest. So they save a ton of money. And so it is very attractive to a lot of small business. But also, some of our large clients are taking that type of policy because they're traders, they're in commodities, or just they basically trust us that we are not going to put the limit, and why not pay monthly instead of pay upfront all that cash. So they would rather go with their pay-as-you-go policy. And it is also 95% indemnity, why not, right? You can also buy a single buyer policy. The reason that a client may bring a single buyer should be a good one, otherwise it will be declined because by nature it is adverse risk selection. So I just want to give you a heads up, if a client is defaulting and continuing paying late, that's a good reason to insure. The reason that a client should think about a single buyer policy is that they have a huge exposure to a single buyer. Either the bank is not lending against that a single buyer because of their high exposure, or because the client the insurer thinks that if this one buyer goes bankrupt, I'm going to get hurt badly. So I need to insure that one, even though they are paying and we have a very long-standing relationship. The minimum credit limit is $1 million. And the minimum premium is $20,000. And it could be short term, as low as 12 months, or it could be medium term. So it could go for FCIA, it can go up to 7 years. But the average medium term transaction that we see, it is typically 18 months through 3 years. So and the medium term transactions are usually capital equipment or high ticket items that the payment will be installments and it will take longer than 12 months or short term to pay. We also have products for supply chain financiers. Basically, there are two ways to approach supply chain financing. One is that the company sells the receivables to the bank, discounts the receivables, and then the bank wants to avoid the non-payment risk by those buyers. So they bring the book to the insurer and they get coverage. It can be again pay as you go. It would be the non-can 90% indemnity, and basically for FCIA it allows to pass back, if there's a claim, it allows it to pass back that 5% or 10% co-insurance to the seller of the receivables. As of the financial crisis of 2008-2009, this product became very popular, and we see it on a daily basis. Basically, a lot of companies prefer to show cash instead of debt and receivables. So it has become a very attractive product for large to medium size banks and financial institutions. We also have payables financing policy, which is basically the client of the bank is the buyer. So the large buyer comes to the bank and say that pay my suppliers short, within a few days or 30 days, whatever, I get me the early payment discount, and I pay you later, maybe 90 days, maybe 120 days, maybe 180 days, or even sometimes longer. So the bank can only take so much, even though this is a solid buyer. At some point, they hit their cap and they say that, okay, I cannot take more. So I need to lay off some of my risk to an insurer. And they come to the insurer and get coverage so that they can basically do more and protect themselves. I have a couple of case studies. I think we have time to go through them. So this is an auto part manufacturer that has $155 million in sales, of which $35 million is export, and the top buyer risk include large OEMs. The challenge that they have is that there's a high concentration on a couple of their top customers, and the export sales is not accepted in the borrowing base by the lender. So they approach the insurance market, a non-cancelable policy is implemented, and the financial institution is able to accept all the borrowing base basically, and they get a higher advance rate, and the cost of the policy is basically paid by lower cost of funding, and the limits are locked in for the term of the policy, so the bank feels secure that the limit is not cancelled in midterm. The second case study is about a winery that has sales of $27 million, with export sales beginning to contract due to competition offering extended payment terms. So the challenge is here that the management doesn't feel comfortable to extend the payment terms, and the sales force wants to sell to new customers, enter new markets, and the management doesn't feel comfortable with the risk profile. So a pay-as-you-go policy is implemented, and basically the insurer agrees that to extend accept the extended terms, and also approve the new buyers in the new market. So the premium is paid through on a monthly basis on actual shipment, and easy on cash flow. The premium savings if price or sales volume goes down. So as I said, if for example, 1 month the sale is 2 million, another month could be less, another month could be higher, the prices may change. So it fluctuates throughout. Therefore, they save a lot on the premium in case the prices go down. And the cost of policy is paid by increasing sales, and it's 90% indemnity, 95% indemnity. So by purchase of credit insurance to avoid being trapped in a financial crisis, mitigate non-payment terms, upsell to existing clients, improve access to financing, avoid balance sheet volatility, reduce package reserves, and get second opinion. FCIA has a lot of underwriters, very seasoned and experienced underwriters. Same thing with other insurers. So it's an opportunity to get a second opinion for the risk profile that basically your company is dealing with, and you can have peace of mind and grow with confidence. What is required to apply for credit insurance? All insurers have applications, all the brokers have applications, but basically the information that is needed is the legal name of the insured, legal name of the buyers and addresses of both, and the limits required for the key accounts, the annual sales, if there have been any losses in the past 3 years, and the repayment terms. And then the rest will come as you submit the application, the underwriter will be in touch and ask for more questions if needed. Just a little bit on FCIA. As I mentioned, FCIA has been around for some time. FCIA, I think this year is the 63rd anniversary of FCIA. We started with writing export credit insurance for the Exim Bank. We did that for 30 years. After that, we became private, and Great American Insurance Company acquired us, and ever since we are a member of Great American Insurance Company, which is a multi-line insurer headquartered in Cincinnati, and started over 150 years ago. And it's rated A+ by S&P and AM Best, and A1 by Moody's. And FCA has a very broad product line, including like import financing and non-delivery, and many other products for banks, for companies. So I would suggest that if you're interested, please visit fca.com to get more information. Very seasoned underwriting team, a lot of experience obviously, and dedicated in-house claims team that basically helps clients to get their claim adjusted and paid in a timely manner. This is the disclaimer, and everything I said, basically it's my responsibility. I'll stop the policy and more information.
Insurance.
And this is my information if you're interested to contact me in the future. Any questions? Yes.
You mentioned single buyer insurance, I think it was slide 10,
Yes.
with extended terms and time limits, up to 5 to 7 years.
Right.
Could you talk a little bit more about that? You mentioned it's often used for like equipment, it has like a long life, I guess.
Right.
So is that geared to like equipment leasing? Is that what that's really meant to insure, or?
Both. So companies or banks that finance leasing basically, they can also get insurance. It is similar to purchasing, except that it is leasing this time. And capital equipment usually have a longer life as well as longer payment terms. Could be installments, like sometimes we don't like it very much. I don't want to advertise it that there's a balloon payment at the end. But basically, these are bigger items like $3 million or sometimes more is the value of the item, and it takes time to make installment payments. And
could you apply that kind of insurance to inventories of discrete components that aren't necessarily so long-lived, that aren't necessarily needed within 12 months? I'm thinking of like spare parts inventories for customers where they don't know when they're going to need to pull that. They might want us to hold it for 3, 4, 5 years. Last time buys where manufacturer has to make a last purchase because someone's going to discontinue product line. So they want to buy 5 years worth of inventory and then bleed it out over time. Could you insure that sort of?
Trade credit insurance doesn't cover inventory because it will be considered a financial guarantee.
Right.
But we can basically cover your receivables because you are selling to your clients and you have a receivable.
Right.
We can cover your receivable, but we cannot cover the inventory because that is not something that we are allowed to do.
But you can cover like a pre-shipment AR, right?
Yes.
Where eventually the client is committed to purchase, so there will be AR at some point, but there isn't AR now because the goods haven't shipped yet.
Yes, but that one, the way it works is that, for example, there's an order. Someone is ordering, let's say, plastic bags, and they want their logo to be printed on that plastic bag. And then before the materials shipped, they say, "You know what? I changed my mind," or they go bankrupt. And so now the company is left with product as well as whatever they have spent on creating this. So if it is something that they can sell into the market, okay, and there's a difference, and there's a payment, so they can file a claim for that. If they cannot sell that at all because there is a logo of someone else on that bag, and now you cannot really do anything with it, so it is a full claim. and it will be covered. But I don't think there is a way that we can say that, okay, I buy the product now and I buy the inventory now, and then I sell it off to the client 5 years from now, 7 years from now. That cannot be part of it.
Please.
Sure. Any other questions?
Is there a minimum, company size that or maturity level when companies start kind of leveraging this sort of thing?
Typically, startups are not attractive because we want to see that the company has been at least a year or two around, and there's a successful track record that they're doing well before we start, providing insurance to them. And also, because there's a minimum premium, there's also the minimum volume. So for domestic sales, annual sales, insurable annual sales, we're looking at $20 million. And for export-only annual sales, we're looking at $7 million, around that number. Different companies have different minimums, but I think it can only go up for most insurers. So FCIA is one of those that still is, asking for kind of a small minimum in the industry, right?
And it also depends on the risk too.
Sure.
Yeah, so if your customer or your buyer has good rating, chances are underwriter will gravitate to that and they may stretch the minimum.
Right, yeah. I mean, relationship, and like, for example, there might be something that it's just a couple of buyers, not a ton of buyers that you need to do. Because it's how much time are you going to do, spend for underwriting that receivable? If only like, handful or a couple of buyers, and the minimum is going to be like $10,000, but only 2 buyers, okay, all right, let's do it. So there are exceptions to the rules, but generally speaking, it's either $15,000 minimum for export or $20,000 for domestic, or 15 combined.
What about the pricing? If the pricing goes up or down, so you basically agree for the order. The prices go down, so it goes up actually in many cases right now. You are basically consider it at a much higher rate, you're not able to do it.
So there are 2 ways to approach this. If you go with the sales volume, let's say that you come and say that, hey, my sales volume is $50 million, and then the prices, let's say, double. By the end of the year, and you have even purchased the non-CAM policy and paid the 80% up front, okay? And by the end of the year, prices have doubled, good for you. What we look at is that the sales is $100 million. The tonnage is the same as we expected, but the volume has got up. So then you owe us that much premium. Let's say that the prices dropped and you sold less than what you expected. So you have paid premium for 80% upfront. You don't get any money back if you sold 70%. That 10% is gone. But you don't owe us any more money. If you sold a little bit more, you only pay us whatever you owe, basically. So it will be adjusted based on the sales volume. So we don't go what the price is, we go with what your sales is. Gone up, whatever it is, basically that is your annual sales, and that's what we look at. With the pay-as-you-go, that's why pay-as-you-go is a very good option. Because even though you might thought that you're going to sell 50 million, by the end of the year, you only sold 25 million because prices drop even though the tonnage is the same. Because the minimum premium was only $20,000, let's say, therefore, you don't owe us any money. You already have paid the minimum premium, so you save a ton of money.
Is that fair to say that pay-as-you-go is more expensive than the?
Absolutely not. That's what people think. The question comes both ways. Some people say that, the non-cancelable limit, the limit is locked in, so is it more expensive? No. Is the pay-as-you-go more convenient? Is it more expensive? No, even though it's 95% indemnity. We offer both options at the same price and let the client choose based on what they prefer. Some insurers may prefer the pay-as-you-go because they say that, hey, I have the staff to manage the monthly review of the credit report and send you the shipment report, send you the premium. Another company may say that, you know what, I don't have enough people to handle this. I would rather just pay up front and not to worry about it. I don't want to be non-compliant. So then it depends on what company chooses. And both options are given to the broker, and FCIA is a broker market. meaning that we only sell through brokers. So both options are given to the broker explains both options to the client, and the client, based on their needs and what their preference is, basically they choose that. Yeah, sure, oops. Any other questions? What do you do? Tell me
I'm
about
not
your
part of the procurement side of it, but I work going CIA for mitigation.
Okay. Since for large companies, I also would say that there are other options. Like, for example, you may come as a banker, as a large company, you may come and say, hey, I want $500 million on certain name. Okay, we're not going to take that by ourselves, because it's too much. So what we do is that you bring your deal to the broker and say that I need coverage for this. And the broker goes to different underwriters and say that here's the deal, how much would you have appetite for? Yes, no, how much? And everyone, based on their capacity and pricing and whatever, they put forward whatever they can do. And then basically they syndicate a policy. And they cover the whole thing through a number of underwriters, but one policy, one pricing, and the broker basically marries all those together, and so that deal will be covered. Yes, there are also other options that we call top-up coverage. Let's say that you have a primary policy with a certain carrier, and then let's say that the primary is offering, let's say, $10 million on a name, and you need 15, and the primary says, I'm at capacity, I cannot do more. So the broker will go to the market and then finds that capacity and then puts that as a secondary coverage.
Right.
Yeah, so there are different ways that we support our insureds depending on what your needs are, and what sector you are, and the pricing changes. The factors that basically go into pricing is that number one, quality of risk. The sector. Some sectors are more volatile. Some sectors are more solid. Some sectors are very good now. They might be very bad a few years ago, but now they're great. Like aviation, they were terrible. Now they're doing very well. So pricing matters. All of these things matter in the pricing. Volume matters. If you have a very large company, large volume, so you have some leverage in pricing because there is economy of scale, so you're getting some discount on that. And of course, the history of losses are important. If your company has been doing very well collecting, not having losses, obviously you're getting a better price than a company that has had losses and they're not doing great. So all of these things factor into pricing for an underwriter. I don't know if there are any other questions, or we just can talk to each other and.
I just want to say some quick thank yous we passed forward.
Sure.
I wanted to thank Nasrin and Peter for talking today, for sharing their expertise and sparking conversations. Thank you guys all for coming out and spending your Thursday afternoon with us. And thank you, ITFA, for making this collaboration possible. And feel free to mingle around in this area or in the comment space of the office. There's coffee and tea. Come up, let us know if you have any questions. And thank you all for coming.
Thank you. Remember one more thing, ITFA has an annual conference coming up in May 15 through 17 in Chicago. If you're interested, please let me know, and I will send you the information. And it's a very good conference. I highly recommend it. There are a lot of different financiers, insurers, brokers, lawyers, companies attending, and it's really a good opportunity to network with all these groups. And I think it is worthwhile. So just wanted to let you know.